Hey guys, it's Aman
and Christina
from Our Rich Journey. The stock market has hit another all-time high. So we can't help but get this question, is it time to sell? People ask us this all the time. And so on today's video, we are going to answer that, but we're going to answer it from the perspective of someone that is pursuing financial independence.
So if you're new to this channel, we achieved financial independence and we retired early at 39. And our YouTube channel here, and our Instagram, and our workbook all shows you ways to reach financial independence and to retire early. So in this video, we are going to talk about whether or not you should sell your stocks. Because right now, in the past 10 to 11 years, the stock market has been going up and we are at an all-time high.
And if you have been investing all of those 10 years, you have a lot more money than what you started with. I mean, just this year alone, you have probably made money. But the reality is, if you have been invested in the stock market over the long term, if it was 10 years ago, 20 years ago, 30 years ago, you have more money. Because investing in the stock market is a long-term game. And that's because the stock market, on average, has returned about 8% per year.
So in our case, the money that we put into the stock market is worth more today than it was when we put it into the stock market. And I'll give you an example from our portfolio. Now, we've been investing since we got out of college, but I really want to focus on the last 12 months. In the last 12 months, our exchange traded funds have gone up so much. VTI is up more than 27%, VGT is up more than 48%, VYM is up more than 20%, and VPU is up more than 20%. And our favorite index fund, which makes up the majority of our portfolio, VTSAX, is up more than 27%. So the question now becomes, if we've made so much money off of our stock portfolio, why not sell it all? And the simple answer is it doesn't support our financial independence plan. It doesn't support our plan or our strategy with our portfolio.
And this is the big part, we believe that the stock market will go higher. Look at any chart of the stock market. It starts down here and it ends up there. And the trend is it will keep going. Now keep in mind, we are not talking about individual stocks. We are talking about the total stock market. And if you've been watching our channel, you know that we invest in index funds that track the total stock market or a sector of the total stock market. Yes, an individual stock, it can go to zero. Index funds, on the other hand, are self-cleansing, meaning that when one stock on that index fund fails and falls off, goes to zero, it is replaced by another stock.
Now, we did a whole video on index funds, and we have lots of videos on index funds actually. So if you're interested in learning more about index funds, check out our video on how index funds made us millionaires. Now, you still may be asking whether or not you should be selling at this point. So we're gonna go over 3 common investing strategies that deal with buying and selling. So the first strategy is the buy and hold strategy, followed by the second strategy, which is buy low and sell high. And the third strategy is day trading. Now keep in mind, when we're talking about these 3 different investment strategies, we're talking about them as they relate to financial independence. And in our opinion, there is only one strategy that will consistently work when you're trying to achieve financial independence.
But we are going to talk about all 3 of them because we want you to make your own decision. And by the end of this video, I think you will understand the concept of buying and selling stocks to achieve financial independence.
So let's get into the first strategy, which is the buy and hold strategy. Now, this is our favorite strategy, and this, in our opinion, is the best way for achieving financial independence. And the buy and hold strategy is exactly what it sounds like. You buy something and you hold it forever.
Now, I want to clarify something. We think the buy and hold strategy works best with index funds because index funds, unlike a company, will not completely fail. On the other hand, a company can go to zero and you can lose all of your money. This is why we emphasize investing in index funds. And when we're talking about buying into index funds, we're talking about dollar cost averaging into index funds, where you are consistently buying shares of that index fund over a long period of time.
So like Aman said, with dollar cost averaging, the strategy is consistency. You're buying when stocks are low and you're buying when stocks are high. What's really interesting is when we say buy low and buy high, buy at all times, it's really interesting because there's really no way to tell when something is at its lowest and when something's at its highest. So dollar cost averaging just means that you are consistent and buying at the same frequency with the same amount.
And I just want to pause on that idea of buying high, because right now people feel like they cannot buy into the stock market because it is too high. Well, what makes you think that it will not go any higher? If you are a long-term investor, you know that history tells us that the stock market will go higher. And as a buy and hold investor, you buy it anytime because your horizon is long. And over the long term, you will have more money in the stock market in the future than what you have invested today.
And yes, it's great when the stock market goes up and it continues to go up, but if there is a stock market crash or there's a dip in the market, that's also great because you're getting things at a discount. You're buying stocks on sale at that point.
So let's get back to the question at hand. If you are a buy and hold investor and you are pursuing financial independence, when do you actually sell your portfolio? And it is when you reach your financial independence number, which is 25 times your annual expenses. That is the point when you are financially independent and you can start living off of your portfolio. And you do that by living off of the dividends and selling stocks that have appreciated.
But the goal is not to go out and sell your entire portfolio. Your portfolio is supposed to sustain you throughout your retirement. So what you really do is you sell a portion of your portfolio just to cover your expenses every year. And by doing that, you're never tapping into your actual principal balance and your portfolio continues to grow.
Now we are referring to the 4% rule, where you can draw down from your portfolio 4% and that portfolio will last forever. Now we talk a lot about this in some of our other videos and we will link to those videos in the description below. So now let's get to the next most popular strategy, which is to buy low and sell high. And this sounds amazing in theory. Everyone wants to buy a stock when it's low and sell it when it's high. The problem is, in practice, this is very hard to do.
And we're talking about this strategy as it relates to financial independence and retiring early. So you may hit a particular stock where you're able to buy low and you sell high, but you have to be able to do this consistently with this strategy in order to reach financial independence and to retire early. And that consistency is next to impossible.
And then not only do you have to do it on your journey to financial independence, you have to do it once you've retired. You have to continuously be buying stocks low and selling them high. That is a lot of work. This is why we like to talk about the buy and hold strategy. But let's dig a little deeper into this buy low, sell high concept. So for example, let's just get into a hypothetical and we'll use an individual stock as an example. Let's say you bought Apple stock at $24 a share and then Apple stock goes to $50. Your money has almost doubled. Do you sell then? And then after you sell, what do you buy? Do you buy something else that is low? Maybe you buy BlackBerry. But what happened to BlackBerry? See, this is a very slippery slope because if you would have just held on to Apple, then you would have so much more money if you would have bought it and held it.
So we gave an example of Apple, but our preference is with index funds. So let's look at an S&P 500 fund as an example. Now, if you purchased this particular fund in 2000 when it was low, and then you sold it in 2007 when it was high, that would seem great at the time. But what would you buy with that money after you sell it? If you look back now, if you would have left that money in at 2000 and left it in up until today, you would have more money by leaving it in.
Yes, you had the recession of 2007, 2008, and 2009, but in the end, over the long run, you would have had more money. And you would even have more money as if during the recession, you were continuously buying and holding. So the point we're trying to make is if you're buying low and selling high, if that is your strategy, you are practicing market timing. And if you are trying to practice market timing to achieve financial independence, it is a losing game. We have not seen anyone able to do this, and we do a lot of research when it comes to investing. No one has been able to successfully time the market year after year after year. So if this is your strategy, you must be a genius or very, very lucky.
So our next strategy is the day trading strategy, and this is the most exciting strategy. I mean, who doesn't want to be involved in that type of excitement? Stocks go up and down, they jump up 20%, you sell right when it hits 20%. It's day trading but day trading is not going to get you to
Oh,
financial
it
independence.
is a scary process. I mean, there are people that do this every single day, and those are the experts. But see, day traders have a system in place. What they're looking for are very small wins over a very long period of time, where they're only looking for 1% each day, maybe a 0.5% each day, and that's how they try to amass their fortune. The problem with day trading is that it is a full-time job, and to consistently do it to achieve financial independence, well, you would be working very, very hard to do that.
And it's not just consistency. Many people fail with day trading. Sure, it's very exciting, but there are significant losses involved with day trading. It's not just that you put a lot of time into it and you do a lot of research and you're successful. The majority of people that are day trading are not successful.
And we know some day traders, and when they talk about their successes, they are very exuberant about their successes. But their failures, they tend to hide their failures. Another observation that we've made is that when they lose money, they feel like they have to make it up the next day or the next week. And so they tend to take on this mentality of almost a gambler, someone that is trying to go back to the casino and win their money back. And when you get caught in that cycle, that's when you can lose a significant amount of money.
So let's get back to the question for day trading strategies. When do you actually sell? So day traders usually put a cap on their wins and their losses. So they buy a stock, and once it reaches a certain percentage, they'll sell it. But if it starts to dip below a certain percentage, they'll sell it at that point also. But I have to reiterate our point from the beginning of this video. It is very difficult to use this type of strategy, this day trading strategy, and reach financial independence.
So those are the 3 most common strategies when people are considering whether or not to sell. But you can also use those strategies when you're considering whether or not to buy. Our point is, make sure you have a strategy. Maybe you're like us and you want to buy and hold. Or maybe you want to hit the casino and be a day trader. The choice is up to you. But our point is, develop a strategy and be consistent with it. And as usual, if you like this video, please give it a thumbs up, subscribe to our channel, and join the journey.